In this video, we discuss the fair value option that's available for financing liabilities. You may remember in Intermediate 1 that we discussed that there's a trend towards the marking to market or fair value accounting. And we learned about it through investments. We learned that when we have an investment in another company, maybe it's stock, maybe it's bonds, under some circumstances we can go ahead and value that at its fair value. We're going to study that more in depth in Chapter 16. But since we're on Chapter 14 and we're talking about liabilities, well, it's time to talk about this one too. As it turns out, you can mark your liabilities, certain liabilities, to fair value. Let's take a look. So it's called the fair value option, and the company can make an election to use to record any, it's both financial assets and obligations at fair value. So why? The fair value improves financial reporting because you can enable entities to offset volatility. So let's say you have a large asset that's being shown at fair value. We want to be able to have the obligation that is similar in structure if we can show the fair value on that end too, so that the fair values can offset each other. It's kind of like hedging, so that you're capturing gains on one side, losses on the other, and they zero out. We'll learn a little bit more about this, but for our purposes, what we need to do is just understand how this works, and we're going to see a lot more of it when we get to Chapter 16. So basically, the election is done one time at the beginning of the time that we have the liability. After a company elects the fair value option, it's generally irrevocable. So when electing this fair value option, the company reports the liability initially at its fair value. We report any unrealized gains and losses in net income. It's kind of like a trading security. If you remember those trading securities, we always did the unrealized gains and losses in net income. So that's how we handle these. Okay, let's look at an example. On January 1st, 2018, Ruffin Corporation issued $40,000 of 4-year bonds that will mature in 2021. The market rate of interest was 6. And you can use the effective interest method. We have payable interest on June 30th and December 31st, but they elect the fair value option for these bonds, and so they have to prepare their financial statements annually. So we need to figure out how those journal entries look when we have to mark to market. So let's take a look. At the end of the year, what we're going to do is debit unrealized loss on bonds for the amount that marks it to market, and we'll call this a permanent account called fair value adjustment on bonds payable. So that fair value adjustment on bonds payable is a related account. It's not a contra, it's an adjunct account. So basically you take your bonds payable carrying value and that amount is added to it to show the fair value. The unrealized loss then goes into net income.